Hi, everyone. Thanks for taking a couple of minutes to watch this video. It's actually going to be a little longer than normal for an email. And so if you don't have time to watch it right now, you might want to come back to it because we're going to be talking about some of the things that are creating risk for a lot of people right now and concerns. Our hearts obviously have gone out to the Ukraine, like everyone else in this world almost, who actually has concerns for human life. And we're hoping and praying for a quick resolution over there with minimal loss of life, praying for strength for all those people who are suffering and those who are refugees. And first and foremost in our hearts is that concern, obviously, for those people. But as an investment advisory firm, we do receive calls as well from folks wondering about how this is going to affect their portfolio and are they at risk and what's going to happen in the future. So I want to take a few minutes to talk about that a little bit and to give you some key things that you can kind of take away, whether you're working with Clearbrook Investment Management or not. So let me share my screen with you quickly here and jump right in. So we want to talk about today just for a little bit the risk pyramid. Now, for those of you who don't work with Clearbrook Investment Management, this might be unfamiliar to you, or you might not know that this is something that we think about in our planning, because typically what happens is people think in terms of their portfolio structure being, do I have an adequate mix for my age and circumstances of stocks and bonds? What they don't understand is both those stocks and bonds, those individual stocks and stock funds or funds, ETFs or mutual funds, are at the top of the risk pyramid. They are what's considered variable return investments. So at the very top, you have things like alternative investments, limited partnerships, real estate investment trusts in many cases are right at the top of the risk pyramid. Then you have individual bonds and stocks. And the reason those are particularly high in risk is not only because they can vary in their return rate, but also because of the concentration of owning an individual stock. Now, people have made a lot of money doing that, but you have to be aware that that concentration rather than diversification does increase your risk. And then you have the diversified funds like exchange traded funds, bond funds, stock funds, and in some cases, variable annuities. Those are all still at the top part of the risk pyramid. At the bottom part of the risk pyramid are things like short duration fixed income, treasuries, inflation protected bonds, those types of things, cash savings, certificates of deposit, money market account. Now, with all those I've just mentioned, there's a common problem that we've been facing for some time, and that's that their return rate is so low, or the dividend they kick out is so low that in particular now it's not anywhere close to keeping up with inflation. And so your spending power is getting lost every single month and day of holding those assets. Then you have fixed annuities, which guarantee you a certain interest rate, similar to a CD, typically a little bit higher than that. You have cash value life insurance, and then you have fixed indexed annuities. Fixed indexed annuities and some cash value life insurance can grow and exceed a fixed rate. It's backed by the strength of the insurance company. So the guarantees are not federal, they're simply by the insurance companies, but they typically have performed pretty well when compared to other guaranteed investments, those on the low part of that risk pyramid. And so when you think about your portfolio, if it's only comprised of variable return investments like the ones listed on the screen here, you're putting your portfolio at a lot of risk, particularly in a downturn. And I'm going to show you kind of what's going on right now, even before we're seeing a lot of increase in interest rates. And the base of the pyramid should also be part of your portfolio. Instead of being just a typical kind of, big box store investment company that has an allocation in your portfolio based on your risk tolerance to bonds and stocks, because both bonds and stocks are at the top of the risk pyramid. They both are variable return investments. And if you can take away one thing from this video, it is understanding that there's a difference between fixed return investments and variable return investments. And that should be prioritized above just a typical what's considered conservative bonds, what's considered aggressive stocks. Okay, let me talk to you about why that is. And it has to do with what's actually going on in the markets. So right here, we have the S&P 500. Let me move myself out of the way a little bit. And so that you can see the S&P 500 index year to date down almost 9.6% as of yesterday. So fairly decent decline, not quite into correction territory, but certainly getting close to that. This is the Fidelity US Bond Index, also a broad market bond index. And you can see that it's down as well year to date, 3.19%. Now, that's before we've seen very many moves in the interest rate. So if the Fed decides to start cranking up the interest rate, you're going to see these bond prices go down, not necessarily the bond yield. The bond yield, actually, the dividend is going to continue to creep up with those interest rate rises. But in your bond holdings, you're going to see prices go down. And that's because prices move inversely to interest rates. Interest rates go up, bond prices go down. I describe it this way. If somebody came to you and offered you a 2% dividend bond, and then 6 months later, somebody came to you and offered you a 4% dividend bond, then the 2% dividend bond that was offered to you before shouldn't be as expensive to you. You should be able to buy it cheaper than you could buy a 4% dividend bond. So when the rates go up, the prices go down, and that's what we consider when we look at total return. And you can see the illustration here, even year to date, if you have bonds yielding 2%, the market is, down, the bond price is down 3.19%, you're negative in your bond portfolio as well. And that's before we've seen much of an interest rate move. And so that's why we think it's super important to really look at your portfolio and consider what's going to happen when the Fed start raising rates, which they're already talking about, particularly when we're seeing over 7% inflation already this year. We think a much safer mix is for people to have variable return investments in their portfolio, well diversified, as well as fixed return investments in their portfolio. Some of those fixed return investments are very frustrating because they're not returning much interest. If you'd like to learn more about that, I teach about these things in the Job Free Future Masterclass series that I do. We've got some coming up. The Assets Masterclass, where I talk about that and a number of other things. The Income Masterclass, which is about filling that gap up there, and also about how you plug the holes in your plan, particularly related to inflation and taxes, super important right now. And then the Social Security Masterclass for those of you who'd like to learn more about Social Security and how to maximize your own benefit. You can register for any of those classes or learn more by going to our website, clearbrook.investments.com. You'll see a link there to the Job Free Future classes. I hope you'll get registered and sign up for those. You can also set an appointment with me if you'd like to have a consultation, maybe a second opinion about the portfolio that you have. That's all I have for you today. And like the rest of you, let's continue to pray for the end of this conflict in Ukraine. Hope you have a great day.